Security Analysis is the most important finance book ever written, inspiring countless famous investors from Warren Buffett, at one time the richest man in the world, to Roaring Kitten, the Wall Street bet celebrity who started the GME meme stock craze. Benjamin Graham, often referred to as the father of value investing, earned his stripes as a highly successful investor and educator. His value investing principles have stood the test of time and served as a guiding beacon for countless investors worldwide, including his most famous disciple, Warren Buffett. Principle 1. Value investing. At the core of security analysis lies the concept of value investing. This philosophy encourages investors to look beyond market noise and identify undervalued assets with the potential for significant growth. The value investing approach involves conducting thorough, fundamental analysis to determine a company's intrinsic value, which is its true underlying worth. By employing various valuation methods, such as discounted cash flow analysis, earnings power value, and comparative analysis, value investors aim to purchase securities at prices lower than their intrinsic values. This approach provides a margin of safety and increases the likelihood of long-term capital appreciation. Principle 2. Margin of safety. To protect our investments from unforeseen risks, Graham and Dodd emphasize the importance of a margin of safety. The concept revolves around purchasing securities at prices significantly below their intrinsic values. By doing so, investors create a safety net that cushions against market volatility and unforeseen adverse events. A prudent investor seeks to ensure that the market price of a security is well below its calculated intrinsic value. This not only mitigates the risk of capital loss but also allows for potential gains, as the market eventually recognizes the security's true value. Principle 3. Intrinsic value. Understanding a company's true worth requires methodical analysis of its intrinsic value. Several valuation methods can be employed to estimate intrinsic value. Several valuation methods can be employed to estimate the intrinsic value of a security. Discounted cash flow analysis. The DCF analysis involves projecting the future cash flows of a company and discounting them back to their present value. By considering the time value of money, we can determine what those future cash flows are worth in today's dollars. This approach allows us to ascertain a company's intrinsic value based on its ability to generate cash in the long run. Earnings power value. EPV focuses on a company's sustainable earnings potential, irrespective of its current market price. By estimating normalized earnings and applying an appropriate multiple, we arrive at a fair value for the company's shares, eliminating short-term fluctuations and market sentiment. Asset-based valuation. This approach assesses a company's net asset value by subtracting its liabilities from its tangible assets. For certain industries or distressed companies, asset-based valuation can provide a conservative estimate of intrinsic value. Comparative analysis. By comparing a company's key financial ratios, such as price to earnings, price to book, and price to sales, to those of its peers or the overall market, we can gauge whether it is undervalued or overvalued relative to its peers. This method provides additional insights to support our intrinsic value calculations. Armed with these valuation methods, we can make informed investment decisions by comparing a company's intrinsic value to its current market price. When the market price is significantly lower than the intrinsic value, it may indicate a potential buying opportunity. Conversely, when the market price exceeds the intrinsic value, caution is warranted to avoid overpaying for a security. Principle 4. Financial statement analysis is a cornerstone of security analysis and a crucial step in evaluating a company's financial health and stability. The two primary financial statements to focus on are the balance sheet and income statement. Balance sheet analysis. The balance sheet provides a snapshot of a company's financial position. At a specific point in time, investors can assess the company's assets, liabilities, and equity. Key metrics to examine include the company's liquidity, leverage, and net worth. Income statement analysis. The income statement outlines a company's revenues, expenses, and profits over a specific period. This statement helps investors gauge the company's profitability, earnings growth, and operational efficiency. By analyzing financial statements, investors gain insights into a company's historical performance, identifying trends, and assessing its ability to generate consistent cash flows. Financial statement analysis is essential in predicting a company's future financial prospects and intrinsic value. Principle 5, Market Psychology. The book emphasizes the role of market psychology in influencing stock prices. Graham and Dodd caution investors against getting swept up in market euphoria or fear, as these emotions can lead to irrational investment decisions. Understanding market psychology allows investors to stay level-headed during market swings and make informed choices. Value investors take advantage of irrational market movements by buying undervalued assets during market downturns and selling overvalued ones during booms. To achieve success, investors must remain disciplined, patient, and objective. By following the principles of value investing, we can maintain our focus on the long-term prospects of our investments unaffected by short-term market fluctuations. Principle 6, Diversification. Graham and Dodd advocate for diversification as a risk management strategy. Diversifying your investment portfolio involves spreading your investments across various securities, industries, and asset classes. The rationale behind diversification is to reduce the impact of individual security performance on the overall portfolio. By not putting all our eggs in one basket, we protect ourselves from significant losses resulting from the poor performance of a single investment. However, diversification doesn't mean over-diversification. Concentrating your investments in a few well-researched, undervalued securities provides a focused approach that enhances potential returns while still minimizing risk. Principle 7, Long-term perspective. Adopting a long-term perspective is a fundamental principle emphasized by Graham and Dodd. This approach encourages investors to focus on the intrinsic value of their investments rather than getting distracted by short-term market fluctuations. Successful value investors recognize that the true worth of a company unfolds over time as its intrinsic value is realized. By holding on to fundamentally sound investments and allowing the market to recognize their true value, investors can capitalize on long-term capital appreciation and compounded returns. Short-term price movements are often driven by market sentiment, news, and other unpredictable factors. Value investors understand the difference between price and value and use this knowledge to their advantage. Principle 8, Contrarian investing. Being a contrarian investor means going against the crowd and having the courage to make decisions that differ from prevailing market trends. Contrarian investors seek undervalued assets that others may be overlooking or unduly pessimistic about. Contrarian investing is rooted in the belief that markets are not always efficient in pricing securities. By taking a contrarian stance and identifying mispriced opportunities, investors can buy when others are selling and sell when others are buying, thus maximizing potential returns. However, contrarian investing requires careful research and analysis to ensure that the investment thesis is well-founded and supported by a solid understanding of the company's fundamentals. Principle 9, Investment and Speculation. Curie analysis draws a clear distinction between investment and speculation. Value investors are primarily concerned with investing in assets with intrinsic value and a favorable risk-to-reward profile. Investing involves conducting thorough analysis of a company's fundamentals, financial statements, and industry outlook. The aim is to purchase securities at prices below their intrinsic value and hold them for the long term, allowing the market to recognize their worth. Speculation, on the other hand, involves making bets on short-term price movements without a strong basis in the underlying fundamentals. Speculative activities often rely on market sentiment, rumors, or short-term trends, exposing investors to higher risks. By differentiating between investment and speculation, value investors prioritize discipline and rationality over impulsive decision-making. Principle 10, The importance of bond security analysis also emphasizes the significance of including bonds in an investment portfolio. Bonds are fixed income securities issued by municipalities or corporations. They represent loans that pay interest over a predetermined period and return the principal amount upon maturity. Bonds offer a stable and predictable source of income, making them valuable for income-oriented investors or those seeking a reliable cash flow. During retirement, they serve as a counterbalance to the volatility of equities, providing a cushion during market downturns. The combination of stocks and bonds in a diversified portfolio can help reduce overall risk and provide investors with a balanced mix of growth and income opportunities. There you have it, an in-depth exploration of the distilled wisdom from security analysis. These timeless principles have stood the test of time and continue to shape successful investors. By mastering value investing, understanding market psychology, and applying a disciplined approach, you can pave your path to financial success. If you found this video helpful, hit the like button, subscribe to our channel, and join our community of savvy investors. Remember, knowledge is power when it comes to making sound financial decisions. Until next time, happy investing!